Saving for retirement can feel daunting. The same goes for managing your money once you've stopped working. That's why we've created an 8-week newsletter series breaking down what you need to consider, both pre and post-retirement, into bite-sized chunks. If you sign up to our free retirement newsletters, for 8 weeks we'll send you an email full of expert guidance to help you take control of your retirement planning and give you the confidence to make smart decisions. We'll help you get to grips with your pension, teach you how to boost your income, and explain more about care options. It doesn't matter when you sign up either. Your 8 weeks of advice will start whenever you sign up. So what are you waiting for? Head to which.co.uk/retirement newsletters, all one word, to get up to speed on everything you need to know for retirement.
When life gives you questions, Which? Get answers.
Welcome to the Which Money Podcast, your weekly hit of money news and personal finance hacks to help make you better off. I'm your host, Lucia Ariano, and here's what's coming up this week.
If a tax return ever becomes too complicated, then that is when you should really speak to an accountant or a tax advisor to help you. Because if you're making errors on a tax return, then HMRC will look at that and then open up an investigation, correct the return, there'll be interest and penalties. So you need assistance at a certain level.
If you think you're going to struggle, make sure you contact HMRC as soon as possible and ask for help. Don't be afraid to give them a call. They may be able to set up a payment plan for you.
This week, we're focusing on all things tax. Now, January is a very important month for those who need to file a tax return. So do you know whether or not you need to file one, and do you actually know how to do it? Plus, there are plenty of tax changes that will impact us in 2025. So we'll explain what those changes could mean for your finances. And joining us to explain all and much, much more along the way, we have one of our resident tax experts, senior writer Matthew Jenkin. Hi, Matt.
Hi, how are you?
I'm good, thank you, Matt. And also Mitch Young, the director of Fusion Consulting Group, a taxation advisory company. Hi, Mitch.
Hi, Lucia.
Well, thank you both so much for joining us today. We've got a lot to get through. And shall we start then with self-assessments? The deadline is looming. You know, January is a very important month for people who need to file their tax return. Matthew, can you give us an overview of the details?
Yeah, sure. So if you have any untaxed income from the last financial year, you have until midnight on the 31st of January to file your tax return online. Unless you have what HMRC considers a reasonable excuse, such as the death of a partner or hospital stay, missing this deadline you're going to face a penalty fee starting at £100, and you're also going to incur interest on what's owed. So don't forget the deadline for filing, but also paying the bill, which is the same day. And if you miss that, you'll be charged interest from the date the payment was due. That's now set at 7.25%. So it's a lot. The longer you leave it, the higher the charges and interest you will incur. If you think you're going to struggle, make sure you contact HMRC as soon as possible and ask for help. Don't be afraid to give them a call. They may be able to set up a payment plan for you. There's also tons of help out there for people finding it hard to fill in the actual form. We at Which, we've got lots of comprehensive guides on the subject, as does HMRC's own website.
And we'll pop links to some useful resources in the description of today's show. And Matthew, so the 31st of Jan, that's noted. And there are other deadlines throughout the year. So it's important to know what they all are and not get confused between their differences, isn't it?
Yeah, exactly. It's hard to keep track of. There's so many dates and they won't be relevant for everyone. But, you know, as I say, if you're filing a tax return, the 31st of January is the date you're aiming for. If you're self-employed, that's also another important date for you, because it's the date you're going to make your first payment on account for the 2024-25 tax year. So that's the tax year we're actually in right now. These are basically, they're advance payments on your future tax bill. And there's also a second installment due on the 31st of July. Another important date to put in your calendar is the beginning of the new tax year, and that starts on the 6th of April. If you're feeling really, really organized, this is the first day you can actually file your tax return.
Can you imagine being one of those people?
Well, you'd be surprised. There are some people who do it. HMRC every year come out with thousands of there's thousands of people who actually do it. It's not me, but but yeah, some people are super organized and like to be early birds. I mean, it's good in a way to just get it out the way. So it makes sense. But if you need to use self-assessment for the first time, though, the deadline for registering with HMRC is the 5th of October. And the cutoff date for paper returns is actually shortly after, on the 31st of October. It's worth bearing in mind with the date for registering with HMRC. That is the very, very latest to do it. So but it's much better to do it as soon as you know you're going to have to do a tax return. Get it done out of the way early on in the tax year, and then you're ready to start. Especially if you want to do the paper return, you wouldn't have much time, and you've also got to wait. I think it's about 10 days in order to receive what's called a UTR number. And that's a very important number that you're going to have to use to fill in your tax return. Finally, if you file your tax return online, now you've got earnings tax through your employer under PAYE, you can opt to have overdue tax collected via your tax code throughout the following year. And you'll need to let the tax office know you want to do that by the 30th of December. So there's quite a few dates, and it all depends on your circumstances.
And should we talk about then who actually needs to file a tax return? Because it's not just the self-employed, is it? I mean, Mitch, do you think there's a bit of a misconception about who needs to file a tax return?
Yeah, absolutely. I mean, there certainly is a common misconception. I think it's because the general individual doesn't know. And, the general person will just likely assume it's just for businesses, business owners, self-employed individuals. And this is where a lot of people do get caught out. HMRC have a lot of information. So the typical people who get caught out are higher earners. So if you're PAYE, and you earn above £100,000, essentially you need to file a self-assessment tax return. As an employee, you're just thinking that your taxes are taken care of by your employer via PAYE. So a lot of employees get caught out. Other people who get caught out are families or individuals who are receiving child benefit. If you receive child benefit, but you're earning above a certain threshold, so if the last year was 50,000, the coming year is 60,000, then potentially you have to submit a self-assessment and start paying that tax back via self-assessment. Then, of course, you have landlords, if you're earning property income. And the biggest ones that I've seen at the moment is individuals or investors who have invested in cryptocurrency in particular. The rules around that and self-assessing are very complicated. A lot of people just assume that if you're exiting the investment, that may result in a transaction. So that's when you need to disclose and declare. But actually, even if you're exchanging crypto, then potentially you'll need to file a self-assessment. And then, of course, if you have things like foreign income, overseas income, bank interest above a certain amount. So there's loads and loads of rules, I guess, in terms of who needs to complete a tax return.
And what about side hustles then? I know that last year HMRC aimed to crack down on people earning money from side hustles. And we talk about it quite a lot on the show, how to make a bit of extra cash selling clothes on the likes of Vinted and Depop, for example. What's the truth here? Are people selling clothes on online marketplaces, say, likely to be impacted?
Yeah. Well, yes and no. I mean, first and foremost, there's a lot of there was lots of hurrah about these side hustles, and in particular, people just selling their personal belongings on the odd occasion or the second-hand items to make a bit of money. HMRC aren't particularly interested in those types of individuals, and on most cases, if you're selling, your old shoes, then that is unlikely to be to be subject to tax. You also have a trading allowance of £1,000 as well, of which you can earn without having to pay tax. But the rules were never changed. What's happened is that there's been an agreement between HMRC and online platforms of a data exchange. So these platforms have to submit data to HMRC on the information that they're getting in terms of who's earning monies. So if you are generally buying and selling with a view of profits and making money, then your profits will be subject to tax, and you need to disclose and submit a self-assessment tax return. HMRC will be writing to certain individuals, so they're going to get the data. And particular for individuals, I think their guidance says around 30 transactions earning around £1,700 of income. They may start writing to those individuals on a generic basis to say that we've received this information. Can you confirm it's correct? And then that's how they're going to either catch people or ensure that people are doing the right thing.
Well, let's say then that you've worked out that you need to file a tax return. Matthew, what do you need handy?
Yeah, so there's quite a lot of documents you're going to need to gather together. A good place to start, obviously, is to go through your bank statements. Make a list of all the different places your money's coming from. You'll then have a much better idea of which income you need to declare on your return and which taxes may be payable. As well as your national insurance and unique tax reference number, that's your UTR number that I mentioned before. Other important documents you'll need to include are a P60 form if you're employed, along with any relevant receipts and invoices. These, for example, these might include tenancy agreements, student loan statements, details of any benefits you've received. Once you've done your tax return, don't throw away any of your receipts, bills, or other paperwork. That's because you might be required to keep, that's because you are required to keep records for a minimum of 6 years. It might also be worth keeping them for as long as 20 years. It sounds like a really long time, but this is the limit that HMRC has to launch an investigation. For example, if it suspects any sort of fraud.
I imagine you speak to so many people who have never filed a tax return before. I mean, what do you hear from them? Is it daunting? I mean, I think it might be. How can you make it easier for yourself?
Yeah, absolutely. I guess there's two different types of people. There's the people who have not realized that they should be doing a tax return, and then, they have a lot of information outstanding. And there's the new people who might just come into income or have bought a first rental property or are setting up a self-employed business. In terms of if you're just coming into self-assessment for the first time, as Matthew said, record keeping is fundamental. Nowadays, there's so many useful tools online in terms of creating spreadsheets or even using accounting systems like Xero or QuickBooks. They both have sort of small business arms to them, whereby you can have everything at your fingertips in terms of an app. You can link your bank statements and just make your life easier for yourself rather than paper-based. There's going to come a time very shortly where every self-assessment comes into making tax digital, so everything is becoming digitalized. So what I would say is that from the beginning, if you're able to digitalize your systems and admin, then that is going to stand you in good stead for the future. I wouldn't necessarily recommend having all your receipts in a paper bag and then trying to put them on an Excel spreadsheet. I would look at some type of system that you can use. And just to say on this point, well, on the first point I raised, for individuals who never realised that they needed to do a tax return, it is very scary for them to try and bring their tax matters up to date. But there are a number of voluntary disclosures available to individuals. So if you're listening and, the typical one is if you have, say, a rental property and you might not realize that you've had to file a tax return, there's something called the Let Property campaign, which is an HMRC voluntary disclosure that you can register. You then have 90 days to bring all your tax affairs up to date. And the benefit of going through the disclosure is that you get reduced cap penalties on the amount of tax outstanding and no statutory penalties on the annual returns which are outstanding, which could be around £1,200 a year. So I would look that up if you're listening and take advantage of that.
Some great advice there. And should we talk about a question probably on everyone's mind who is filing a tax return? Mitch, are there ways to reduce your tax bill?
Yeah, absolutely. It obviously depends on your circumstances because there's different rules depending if you're self-employed, employed, have income tax or capital gains tax. I think it's worth mentioning that a self-assessment is just not for income tax, it's for capital taxes as well. But for income tax, you certainly may want to consider, if you're a high rate taxpayer, things like pension contributions, charitable donations. Charitable donations can often get missed. So if you're a high rate taxpayer, you look at including those on your tax returns, and the gift aid amount in particular, that helps extend the basic rate band. So more you pay in the 20% bracket. And then, of course, for self-employed individuals and landlords, you have allowable expenses to deduct against your income, thereby reducing the profits. So there's lots and lots you can claim against that. It's good to get into the mindset in terms of what you can claim is that think of any expense that you're incurring for the purpose of your work or the purpose of your property, then list them all down, and then you can check on the HMRC website, gov.uk, or indeed speak to a tax advisor or accountant. So you don't want to miss out on anything else. Then for employed individuals, there might also be things you can do as well. There are expenses that you've incurred wholly, exclusively, necessarily for the purpose of your employment. You can claim against your employment income, and that may help reduce the tax. And that could be things like your mileage, if you haven't claimed that through your work. It could be if you're a tradesman or a professional whereby you have to pay for your uniform, or even sportsmen and women, some of their equipment. And then finally, if there are things called tax efficient investments, so you'd need to speak to a financial advisor and get independent financial advice. But from a tax perspective, if you invest in a HMRC tax efficient investment, you could get tax relief on those investments, income tax relief in that year, 30% on average, thereby reducing your tax bill. But of course, with anything tax advice, tax planning, financial advice, you really should speak with a professional.
I'd like to add as well, don't panic. Give yourself enough time to complete the form. Rushing can lead to mistakes. And, while you can go back and make corrections if you realize you've made an error, it's much better to get it right the first time. And as I mentioned earlier, Which has loads of helpful guides and articles to help make the process easier, including calculators if you're struggling with the maths.
And we'll get links to some of those in the description of today's show. Okay, now after a quick break, we'll be back explaining what you need to know about the wider tax changes for 2025. We'll be back after this.
If you're enjoying this podcast from us here at Which, then why not become a Which member? Right now, we've got a special offer, especially for podcast listeners, meaning you can choose any of our 3 membership tiers for 50% off the usual price. Starting at just £39.50 for a full year, you can get Which magazine delivered direct to your door. For the same price, you could also choose a digital Which subscription, giving you access to all of our product reviews, the Which app, and the digital edition of Which magazine. What's more, you'll also be able to use the Ask Which service for personalised one-to-one buying advice. Or why not get a full access Which subscription for just £49.50 for a full year? Don't forget, that's 50% off the usual price. To join Which or to find out more, just head to which.co.uk/podcast offer. That's which.co.uk/podcast offer, or click the link in the description for today's podcast for 50% off a Which annual subscription.
Welcome back to the show. Now, cast your mind back to the autumn budget in October last year. There were plenty of tax changes revealed then. So let's go through them now and explain what they mean for all of us. Matthew, can we start with capital gains tax?
Yeah, sure. So this is an important change. If you make income from selling assets, such as investments or valuable possessions, capital gains tax is charged on the profits made from these sales. And at the autumn budget, the Chancellor announced that CGT rates on assets would increase from 10% to 18% for basic rate taxpayers and from 20% to 24% for higher rate taxpayers. The change took place immediately and brought CGT rates on assets in line with rates on selling a second property. But remember, you'll only pay CGT on any gain you make rather than the sale price. Gains can also be offset against losses when made selling other assets. So there is a way to sort of reduce those costs. If you're filing your tax return this month, you only need to worry about rates for the last financial year, of course. But it's something to keep in mind for next year's self-assessment.
And Matthew, what about stamp duty?
Yeah, so the current extra stamp duty relief for first-time buyers and home movers in England and Northern Ireland is set to end on the 31st of March 2025. So from 1st of April, the stamp duty threshold for first-time buyers will drop from 425,000 to the previous rate of 300,000. From the same date, home movers will pay stamp duty on purchases over 125,000 rather than the current 250,000. For example, based on the new thresholds and stamp duty rates, a home mover completing on a property worth 500,000 in England or Northern Ireland would pay £15,000 in stamp duty rather than the current level of £12,500. The autumn budget also held bad news for anyone looking for a buy-to-let or second home. It was announced that stamp duty for buy-to-let properties and second homes would increase by 2 percentage points. That change, like other changes, took place immediately. If you live in Scotland or Wales, stamp duty rates and thresholds are different. So you might want to take a closer look at if you live in those areas, what the rules are there.
I'm sure our listeners will have seen that there has been a lot of debate around inheritance tax on farms, and other estate owners could end up paying inheritance tax because thresholds were frozen. Is that right, Matthew?
Yeah, that's right. So while in reality, only a very small number of people are actually stung by this levy, there's just over 4% actually. If your estate is worth more than 325 grand when you die, your beneficiaries will be liable to pay inheritance tax of 40% on anything above this threshold. The current IHT thresholds were due to be frozen until 2028, but this has been extended now until 2030. So the problem is that as time goes on, the impact of inflation means that more estates are likely to exceed the frozen IHT threshold. And it's also worth adding that another change that came in was that unspent pension funds will also count as part of your estate for IHT purposes from April 2027. Obviously, that's some years away, but you might want to consider it now when making plans to pass on any assets.
And shall we talk about a tax that affects many, many more of us, and that's council tax? Mitch, is it likely our council tax bill will be going up in April?
Yeah, I'm afraid to say it is looking likely that council tax is going to rise. They've essentially been given around 5% without needing a referendum. This could mean quite a large rise for everyone's council tax bill, depending on where you're living. Up to 5% it could go. So the advice would be to keep an eye out from your notifications and letters and things you get through your letterbox from your local authority.
And is it worth checking if you can get a reduction on your council tax bill, or, even see if you're in the wrong band?
Yeah, absolutely. I think, given that the council tax is quite a large amount of someone's monthly expenditure, I think it's certainly worth checking. And it may be that you do qualify for discounts or exemptions, such as a single person's discount or reductions for disabilities. But additionally, many properties in the UK could be in the wrong band and have been for many years, since it was first introduced in 1990, I think it was. So if you suspect that your property is incorrectly banded, then you can challenge that banding through the Valuation Office Agency in England, or I believe there's also an equivalent in Scotland and Wales as well.
Now, national insurance. I mean, it's on the surface, it doesn't look like it'll impact employees, but it couldn't it, Matthew? It's an increase in employer national insurance contributions. So how could this hit us?
Yeah, so this is one of the most contentious tax changes that was included in the autumn budget. There's been a lot of press coverage. While it's true that it only applies to employers, businesses and experts have been warning about the potential impact it could have on workers. So what's changing? Well, the government will increase national insurance contributions for employers from 13.8% to 15% from the 6th of April this year. The threshold for when employers then need to start paying the tax will also be lowered from £9,100 to £5,000. So, as I say, these changes won't affect most people directly, but some critics suggest that it could have a knock-on effect on employees, and that's through employers offering lower pay increases or less generous employment benefits in future.
Well, we've covered so much ground today. It's been a bumper episode, and we've flown through a lot. Would you like to leave our listeners with, any final nuggets of tax advice? Mitch, do you want to go first?
Yeah, I mean, I'm going to be quite boring just to say that, it can be quite daunting to do a tax return. There's a lot of data and information that you need to get right. So don't be afraid to pick up the phone to your local accountant or local tax advisor. We don't bite. And, most accountants and tax advisors will happily spend 15, 20 minutes with a new new client, give them some generic advice. And then, of course, they would quote to assist them with their tax return if they wanted at that point. So if you've reviewed everything online, but you still want the reassurance of speaking to someone, then go and speak to your local accountant, call them up, or your tax advisor, and they would be happy to speak with you for sort of 10 or 15 minutes.
Yeah, and my sort of final piece of advice would be, when it comes to self-assessment, the most important thing, as I said before, is to meet that deadline. If you haven't started filling in the form yet, just do it now. And remember, you can make amends after the tax return is filed, but the big thing is getting it in on time to avoid a fine.
Well, thank you both. It's been a brilliant episode. Thank you so much for joining us today.
Thank you.
Thanks very much.
Well, a huge thank you again to Matthew and Mitch for coming on the show today, and to you for listening to this week's episode of the Which Money Podcast. If you enjoyed today's show, please do hit subscribe to make sure you catch our new episodes as soon as they drop. For daily money news and advice, you can find us on social media at Which Money and online at which.co.uk/money. And we also have a free money newsletter, which is delivered to your inbox every Monday. To sign up, visit which.co.uk/money newsletter. This episode of the Which Money Podcast was presented by me, Lucia Ariano, and produced and edited by James Rowe.
Next time you need to get work done on your home, or your car, or your garden, make sure you choose a trader you can trust. And don't just choose any trader, choose a Which trusted trader. Our trading standards professionals only endorse traders who've passed our rigorous assessment that includes credit reports, customer satisfaction surveys, reference checks, and interviews. When we say a trader is good enough to display our Which Trusted Trader logo, you can trust us. But don't take our word for it. Search Which Trusted Traders online to see our directory of around 4,000 traders. Every customer review you read there is verified genuine by our moderators, so you can choose with confidence. To find a local trader you can trust, search Which Trusted Traders or go to which.co.uk/traders. That's which.co.uk/traders. Everybody needs a trader they can trust.